known George for a long time from when I was living in Vancouver. George is a professional engineer, which we do not hold against him. He's been in the real estate and IT business for upwards of 25 years and has a wonderful company called RealNet Canada, which most of us who are in the business are quite familiar with. Refers to RealNet as the Bloomberg of real estate information for Canada. Perhaps the Reuters of real estate information might be more appropriate. George has participated, very active in both the Canadian marketplace and as well recognized as an expert relative to his views on housing, condominium, as well as the general ICI markets. Very entrenched in the real estate community with being the past president of NAIOP and being part of the founding group that came up with the Rex Awards that I think are up on the 7th of March for those that are interested. So I'm not going to take any more time. I'll ask George to join us and hang on to your hats because this is always a wonderful presentation.
Well, thanks, Bob. It's a pleasure to be here this afternoon with you. And thanks to Ray also for warming up everyone on the texting for this afternoon session. I'm going to talk a little bit about the GTA development market. That's going to be the focus of my presentation to you all this afternoon. So I'd like to kick off, actually, before I tell you what I think is going on, maybe you can help me with our first poll and tell me what you think is going on. So this is really about the condo market. Do you think we're set for a major price correction? Do you think that we're set for perhaps a more modest price correction? Do you think everything is absolutely fine and there is no problem here? Or D, the honest perhaps answer is, I have no idea. So maybe if you wade into your phones on this one, let us know what you think. Coming on here. Oh. There you go. A few more over there. Okay. Your call. What do you want to call? Okay, well, that's kind of interesting. I think, well, no problem. No problem. Ahead by a nose. No, wait. No, still no problem ahead. That's interesting on the polling. So I think what you're, the doomsday people are not in this room, is what this is telling us. So if we can, let's go to the back up one slide. So really the theme of my presentation here is kind of interesting. I offer this up to you as really a contrast from what most people are thinking is going on in the market to what is actually going on in the market, all separated by that one very important, powerful, but little f in that word, because that if without the f in that word, it could be kind of dicey. And I think, honestly, what you'll see is, depending on what happens, what actions are taken by the industry this year, that little f could disappear next year. So what you'll see, I think, in the slides that I have before you is that the GTA development market has really entered a new era. By every measure and gauge, you'll see that we're either at record levels or have actually created new record levels in the housing market. And what you're going to see that this $22 billion a year market is something that we are all in together. Whether you're in the industry, whether you're in government, whether you're a consumer, we are all in this one together. And I think what's important as we enter the new era is how we begin to think about the decisions and how we begin to think about the actions that we're going to take, in particular the actions in 2012, because what happens in 2012 is going to be absolutely vital to the outcome of 2015 and 2016. So scope of the briefing here, I'll go through the facts. So we'll digest the actual results for 2011, still relatively fresh. I've got a stress test. We've got 4 critical analyses to run through on the development market. We talk about affordability, talk about supply, we'll talk about some of the stress tests in the development pro formas, and then we'll talk about the condo investment and what rental backstops actually look like, and then open up for some questions. So first on the delivery of the numbers, what was a very boisterous year last year. On the ups and the downs, a lot on the up last year. New high-rise sales last year for new condominiums, record level, but high-rise sales were not really limited to the 416. The 905 now showing some really dramatic, in fact, record share of high-rise new homes in the 905. And those surging high-rise sales, whether they're 416 or 905, helped buoy the total new home market to its second highest level in history. I want to give you some context to that because it's not really working at a step. When you look at the resale market in the GTA last year, it too was at its second highest level on record. And when you look at capital flows, the commercial real estate assets here in the GTA, Ray, when he talked about his numbers, they were national. When you look at the GTA numbers, capital flows in the commercial property markets, record high last year. On the land side, which formed part of those numbers, we ended the year with a record level of investment in residential land assets. When you look at pricing, the low-rise new home price was up about 8% year over year, and really not out of step with the overall market because resale was also up about 8%. On the going down side, what might be a bit surprising is what went down was the high-rise price. And it went down not because costs went down, it went down because units got a lot smaller. We dropped about 52 square feet on the index size of a unit last year, down from about 100 from the prior year, from the last 2 years. And with all that high demand and low supply, what you've seen is months of supply in new homes now at a record low level across the GTA. So let's get into the analysis, and we'll start with the commercial investment market. These are capital flows of assets in the GTA: office, retail, industrial, apartment, hotel, and land. Dollar volumes are the bars, and the line is the number of transactions. And you can see 2011 ended the year at $12.7 billion is what we've got here. That's an important number. I want you to remember that number when we try to compare other sectors. About 300 million ahead of 2007 in the GTA. So 12.7 is a record year. When you look at how that was distributed across the various asset classes, here's what you find. You know, retail in quite strong, 23%. Office having a very strong year at 21%. And land really being the big destination for investments in the GTA. 31%. When you look on the inside of that pie chart, it tells you a clue as to what kind of land assets you saw. About 3/4 of those were around residential. So we're investing in places where people are going to live as opposed to where they're going to work or where they may shop. When you move a little forward into the yield component, this is the cap rate analysis, but this is just the GTA. A few things to start to keep in mind. Retail is your red line, apartments, your blue line, industrial, yellow is office. And down here is the risk-free rate, still relatively risk-free because we're in Canada, of the Government of Canada 5-year bond rate. A few insights that you'll see out of this is every asset class started to trend down again in cap rates in 2011. You're seeing us hit levels that we saw back in 2007. The difference, though, is in 2007, where was that green line? So although these rates are now at, or in fact in some cases like retail and apartment, reach new record lows, the spreads here over the risk-free rate are almost double what they were back in 2007. So I think if you think about what may happen, as Ray was talking about in the markets this year, if the hunger for yield in commercial real estate as an asset class and relative to anemic fixed income returns, 2%, real estate starts to look very attractive. So if it looks attractive enough to demand the same kind of compression we saw back in 2007, you could argue that you could see a drop at about 2% in the cap rates across the board. That, as Ray said, might look really exciting for owners of assets in 2011, but what it would do is put us in a really dangerous position depending on what happens with that green line sometime out in the future. So take a look at the housing numbers. These are the results, official results we released on the 20th for build. So total new home sales in the GTA, 45,926 units. When you equate that into different terms, into dollars, let's say, that's $22 billion of investments, purchases of new homes across the GTA. Your high-rise, 28,466 units. That's a new record high level in the GTA. That's up 35% from prior year. When you do the math on that, that works out to $12.7 billion. So for those of you who stored the commercial sales memory in your mind, as many dollars flowed into commercial real estate assets in the GTA in 2011 as did into new condos in the GTA in 2011. It gives you a sense of the size of that market. When you look at the low-rise number, 17,460, that is up 7% from last year, but it's the third weakest year that we've had on record in the GTA. On the inventory side, where low-rise inventory historically was in around 20 to 24,000 units a year, it's now reached a new record, but a new record low at 5,800 units. Your inventory on high-rise, 15,000, right there, that should give you a sense of consumer choice. 3 homes, 3 condos for every 1 low-rise that's available in the marketplace. And the low inventory here has driven record low levels of available product in the total new home market. Months of supply, when you express sales and inventory, only 4 months for low-rise. And what you thought might be a lot in high-rise, only 6.5 months and more when we drill into the details for that. Index price, $545 for a low-rise home, $434 for a high-rise home. This is what the good old days used to look like in the GTA. When you looked at how new homes were distributed from a product perspective. Detached homes, 43% of the overall market. These green wedges here are what we refer to as low-rise. So low-rise represented 3/4 of the market. High-rise, apartments, lofts, and stacked, represented about 25% of the market. That's what it used to look like. This is what last year looked like in the GTA. This is the shift, the formation of what you're seeing as a housing shift. It's a shift towards high density. So you can see here now where detached used to be 43, it's half of what it used to be. And in fact, the ratio now is almost 3 to 1. We've sold about 3 times the number of apartment units as we have detached homes. And what you saw based on supply of available inventory, you can't sell what you don't have, that trend is going to continue into the future. And when you look at some of the key names on this, Mattamy Homes, our largest builder in the GTA, still 1,884 units. #1 builder on the high-rise, Tridel, 1,664. Interesting when you start to look at the top 10, top 10 and how much weight do those top 10 builders carry? About 1/3 of the market overall, which means you have another 170, 180 players representing about 2/3 of the market. So this is a very fragmented market overall. When we talked about the 905, an area of the GTA that we would typically associate with Suburbanville, typically in the 905, most of our new homes were low-rise homes. Back in 2000, only 5% of new home sales in the 905 were high-rise homes. What you saw take place in 2011 is the amplification or the increasing rate of that shift. 32%, almost 1 of every 3 new homes in the in the 905 last year were high-rise homes. And based again on inventory, you're going to see those lines start to cross someplace out about here. One of the things that's vital to understand is the dynamic between sales and inventories. We're going to talk about low-rise here for a second. So these are detached, semis, towns, and links. This line here is the sales. These are monthly sales of low-rise homes across the GTA. Behind it, these are the bars. These are what's left unsold, the active inventory by builders in the market at the end of each month. What you can see here now is we're now, you can't sell what you don't have. We're now at record low levels of low-rise at 5,800 units. And really, that's down by 73% from where we were just a mere decade ago. Without understanding that as a backdrop, it's really difficult to put high-rise into perspective. We'll talk about high-rise just in a moment, but I wanted to give you a sense of what really what supply looks like if you're looking for a low-rise home across the GTA. 4 months of supply overall as of December, but when you start to drill into the product types, you said, well, how much supply do we have of 45-foot detached homes? We have 2.5 months. By the time those stats were done, we might be out in the next 30 days. When you look at even townhouses, 2.3 months of active supply in those areas. So you're really now in the low-rise side running on empty. Without knowing that, the high-rise picture starts to become quite alarming. So this is the high-rise equivalent. So what we saw is sales increase. Inventories are the bars behind it. Last year, we added a record new number of projects to the market. There was 130 new condos that were added to the market. That added a new availability of 28,390 units. Last year, as you recall, we sold 28,466. So last year was all about absorbing absolutely everything that we put onto the market and a little bit more. The real risk here is that from most people's perspective, it's pretty hard to miss a 30-story building being added to the skyline. In fact, there's a lot more of them being added today than there were just a few years ago. So optically, it's quite alarming. What's easy to miss, unless you do what we do, is witness the shrinking amount of subdivisions that once existed in the GTA that are now increasingly not present. And because of that, the shift of housing is very invisible to most people. But when you look at high-rise, we're left at about 15,000 units. So from an alarming perspective, that inventory is pretty much the same level of inventory that we've had over the last 7-8 years. When you drill down into the high-rise inventory, you can see that although overall we're at about 6.5 months of supply, when you start looking at some of the smaller unit types, it's even lower. So what might be counterintuitive, you think there's a ton of availability for 1 bedroom and 1+ den. Not true. Between 4.7 months of that supply. On the larger units, your 2s and 2+ dens, a little more. Not because we have a lot, it's just because the demand for those types of products just don't exist as much as the smaller ones. When we talk about what's happening in price, low-rise price here is your green line. High-rise is the orange line. That gap between low-rise and high-rise now sits at the largest gap we've had on record at about $111,000. And you can see the formation of that gap has less to do with the increasing high-rise number, although that went up about 8%. It's more to do with the declining, declining high-rise number than the rising low-rise number. And when you dig into this a bit, what happened? Why is that price going down? So let's take that yellow line and break it into its component parts. Price is a product of unit price, price per square foot, and size. So when you see unit price per square foot, that's been going up. In fact, that went up by about 4% last year. It went up by 4%, but our total price went down by 2%, and the reason for that is size. We lost 52 square feet in the last 12 months, and if you look at it, we lost about 100 square feet in the last 2.5 years. Interesting, and this is a tax phenomena, that happened to coincide with the introduction of the HST. The moment the builders had to deal with issues of rising costs, and you have to maintain a level of affordability, your one immediate remedy is to make those a little more efficient and a little smaller. And that's what we've seen in the condo, is that the pricing has come off, but because unit sizes have now come down. When you compare the unit price for new versus resale, you get some interesting insights. So the gap between a new condo and a resale condo shown here, the gap used to be about $70,000, is now about $134,000. So the gap is widening. It's also some great headline fodder. Before you run off with a quick conclusion on what that means, I need you to think a little bit about what the data actually is that we're covering here. In this bottom resale line, there's something in the order of 250,000 condos that exist today. They exist today because some of them were delivered last year, some of them were delivered in 1973, and on average about 1,100 to 2,000 of those trade every month. This is the median price of those that happen to trade, regardless of whether they're a year old or whether they're 30 years old. The top line is a new home price. What is that? That is a futures contract. Every month we measure that activity. That is born out of a universe of about 15,000 units that are largely in pre-construction or under construction. Those units don't exist yet. And with the increasing size of the projects, it is not uncommon to see about a 4-year lag between the time someone lines up, not so much anymore, but gets their broker to bring them into the VIP event and they buy that unit. 4 years between that time and the time they say, here are your keys. So if you model a 4-year time lag into that price, what you find is really quite interesting. You find that the new home price modeled 4 years after is actually quite in line with the resale price at a small premium. So what you're seeing here is that as a universe of 250,000 older condos get diluted with 15,000 units of more valuable, more expensive, and newer real estate, that price has been moving up over time. It brings in some interesting concerns, though, because this is now saying this is the closing price for those units out in 2015 and 2016, which raises some questions, and that's where I want to sort of introduce the stress tests on this market. And we'll look at 4. We'll look at housing affordability, we'll look at supply, we'll look at land and pro forma relationships, and then we'll look at the rental numbers. So kick off with the concept of affordability. This purple line here is the average resale home price in the Toronto area since 1980. And you can see the period in 1989, correction, and then off we go. Layer on to this analysis incomes. That's your green line. And you can start to visually see the trend differences here. Home prices are going up much faster than incomes are rising. And then we introduce a very powerful economic measure, one that's made itself into the Economist magazine and has gone across the world and is talking about the price to income ratio. And we see where is Toronto right now at about 4.5 times, eerily familiar to the period in 1989 where it once was before we had a market crash. Well, a very true and correct measure. What we've got to remember, though, is that affordability is not just about incomes and price. It has also to deal with interest rates. So if we take that same analysis and introduce the red line's interest rates over that last same 30-year period. And for those that remember, when interest rates were 18%, good long-term memory, that's when it was. But what you're seeing in interest rates is a long-term secular trend of declining rates. So it begs the question, what's fair price? So in this analysis, you would say, how much house can this income buy at these interest rates? And if we did that together, basically combining the green line and the red line, I'll introduce you to the blue line. The blue line now suggests what fair pricing actually represents. And what you see here is, yes, in the point in time in 1989, the purple line, resale price, had a significant gap over what fair price was, and it corrected. Now, ever since then, what you've seen, largely due to declining interest rates, is that price has done what it would normally do, is draft up to where fair price would be, to a point in time now where there's a small delta, a small cushion, if you will, between the resale price and that fair price in the GTA. Layer on now the new home options. Green line is low rise, the orange line is high rise, and you can see really some spread there in affordability relative to the mean GTA income and rates. Stress test it. Stress test it, because now we're going to say, what does 4 years out look like? Because if you're a developer and you're selling a condo, you want to sell that unit today, and you just have to hope that they're going to be there 4 years later to actually close on that unit. So 4 years later, where are rates along these different profiles? But it's not just about rates, it's also about income. So if you see shocks to the Canadian economy, to the Ontario economy, you might see those start to manifest themselves in lower wages. You might see those rates go up. So where are we today? relative to where we could be in the worst case. I come from a Greek household, so disaster is always around the corner everywhere, so I'm always focusing on here. You could argue there's some upside. You could argue that, you know, the rest of the world goes to hell in a handbasket again. We have to drop our rates and we fare okay, so we skate up towards the top left again. Let's not focus on that part. Let's focus on this part. So when we do that, what we're seeing here is here's that same affordability line in where we are today. 4 years hence, where could those two outcomes be? And this is based on 25-year AM and 32% GDS. So you could see an 11% decline in that price 4 years out based on some of those scenarios. Fortunately, Minister Flaherty still has kept the 30-year AM and the 35% GDS in play. So if those still are in play in 4 years from now, we should be fine. Should be fine, but if you have to rely on that, what it's suggesting is that the people who have to close are going to have to pay a lot more of their income towards housing costs, which may take away some of their ability to buy those, you know, flat screen TVs, although the iTV might be the real game changer there. But you may have to pay more out of your pocket for your household, and you may have to do that a heck of a lot longer. So what I want to do then is look at the other issue of oversupply. Oversupply I'm going to address from the concept that people have to live somewhere. This graph here is showing you what population growth looks like in the GTA over the last 30 years. This is how we grew by 2.5 million people since 1980. What I'm going to do is layer on now, beside the population growth, new home sales. These are total new home sales, high-rise and low-rise, since 1980. What you can see is since really 1990, new home sales have lagged population growth. In other words, people come and then we sell homes. And if you think about that, there's a further lag because you have the sale first, then there's a start, and there's the occupancy. So deliveries further lag population growth. If you look at the last 10 years here, what we've seen is, on average, about 98,000 people. We've grown by about 98,000 people per year. And we've sold, these line up very, very well, about 40,000 new homes per year. So from an oversupply perspective, I want you to think about these numbers in sort of general terms. For every 10 people that we grow by, every 10 more people that exist in the GTA, we sell 4 new homes. That works out to about 2.5 people per home. If we're thinking about oversupply, that kind of ratio is really not out of line with the rest of Canada. Now, the question is going to be, what kind of homes do we have? So let's keep that same red line, make it a little lighter, and break down total new homes into their component parts. Low-rise homes is the green, high-rise homes is the yellow, and this is when the shift started. This is the introduction, 2003-2005, of the growth plan. This is the way that the province envisioned the growth of this region, which is essentially a grow up, not out approach to planning. Something not really known by many people who can spot lots of condos manifesting themselves around the GTA. The shift has now hit the fan, but the shift started back here. And you can see that. You can see how the trend since that time, as municipalities constrained their land supplies, entitlements process became much tougher, low-rise declined, high-rise increased. So naturally, that's what we're seeing is the transition of one form of housing to another. Although we can sell those units, there is a growing perspective that we may not be able to build enough of those units. So from an oversupply perspective, think of this. Last December 2010, when we looked ahead into scheduled deliveries of new condos in the GTA, based on us going to every single project every month and looking at when they scheduled their deliveries, we would have expected about 22,000 units to be delivered into the market. We didn't deliver 22,000 units. We delivered about 14,000 units to the market last year. And that's a delta of about 7,000 units. So you'd ask yourself, what happened to those 7,000 units? In one word, delay. So this would have been interesting if you caught that data pattern once, maybe twice. For the last 7 years, this market has been working at full tilt. There is no idle capacity in the Toronto high-rise construction market. And with everybody working full tilt and proving that out for the last 7 years, if all we can manage to deliver is about 15,000 units. I want you to think a bit about the big numbers and think about what kind of supply risk we have. If we grow by 100,000 people a year, and we need about 40,000 new homes a year, household formations, to keep up with that population growth. If your low-rise engine is out of gas, your high-rise engine hasn't been able to deliver more than 15,000 units, the supply partner we might be dancing with going forward is less over, and maybe, I would argue, more under, or perhaps wrong, depending on the kind of units that we're delivering. I want to move on to number 3, which is an interplay between what's happening in the land space and in the pro formas of the condo developers. When we look at land investments in the GTA quarter by quarter, what you've seen in the fourth quarter, and this would be no different if I showed you the Vancouver numbers, record dollar volume being invested in residential land assets in the fourth quarter. About 52% of those were high-rise land assets in the GTA. When you look at what's been happening on pricing, pricing for high-rise is this orange line here. It's $56 a square foot. That's the average for the GTA. That's Burlington to Clarington. And a few points on that. But I want to talk a little bit about this purple line, which is townhouse land. We saw that start to outpace its retail product growth in 2009. 10 and 11, we've seen it rebound. We've seen it recover basically in line with its long-term trend. On the high-rise price, which is really critical to this pro forma test, $56 a foot on average in 2011. Two insights that are not reflected in the graph. One is a lot more approval risk being accepted in that price today than there was as little as 2 years ago. And if you were to see downtown numbers, that would easily be 40, maybe 50% higher for a downtown site versus GTA. So from a builder's perspective, the business is very similar. The risks are very different. When you shift fulfilling housing demand from a 300-unit ground scraper subdivision project to a 300-unit skyscraper project, the risks inherent in the marketplace are very, very different, particularly from a resource perspective, particularly from a capital perspective, and also because the bets you are making are going to take between 4 and 5 years to actually pan out. So you might be making a bet on the land market today with a given set of economic conditions. You may want to go plan and design and sell that in a market 12 months from now with a different set of economic conditions. Go to the construction market in 24 months, different set of economic conditions, and then close in 2015 or 2016 with arguably another set of economic conditions. So when we looked at the stress testing here, we said let's look at the key elements of that: land, hard costs, mortgages, rates, and income, and then model 3 different scenarios. So the 3 scenarios that we modeled: low, moderate, and high risk. On the land side, 5% increase on land, up to 20% increase on land. So when you look at that, that's about $12 a square foot increased in land values from where they are today. On the hard costs, we had some help from a great man, Mike Barker, who ran Altus Hellier for 20 years. And he gave us some insights on what that would look like. So costs going up, perhaps on the high-risk scenario, about 10%. And 5 years forward, where would rates be? 4 years forward, where would rates be and where would incomes be? And we modeled those 3 different scenarios. 2 types of analyses. We're doing one that's a top-down analysis and one that's a bottom-up. On the top-down, we said if you kept prices where they are today and then modeled those same risk profiles for closing risk, you would find from an affordability perspective, our current price holds up very well. So currently, we're priced below affordability. If we saw rates start to move up a bit and income start to soften a bit, we start to have some risk, but not a lot. In fact, even this high-risk scenario, if you look at having a 30-year AM and 35% GDS, your current price holds up really well. That's a really, really, really important message, particularly to the development community. If you hold those prices to where they are now, your risk of having them come back to you 4 years from now is very minimal. But in each of these cases, costs go up. So if you said, what's the impact of that, and this is helpful for the land residual folks in the market, what's left over for land and profit? Well, this is where land is currently in the marketplace. So if you're expecting some of those cost pressures in the future, there's going to be a tug-of-war that's going to happen between the landowner and the developer who wants to buy that site, and it could be as much as $32 a square foot. The market this year will determine who gets that 32 bucks. Was it the person who owned the land, or is it the person who's going to buy the land and take on all the risk to deliver the housing? That was the top-down. Your bottom-up analysis assumes that we will merrily go about our way and absorb those cost increases. We will pay more for that land. We will absorb those increased hard costs, and we will reflect those into the end price, and we will sell that unit. Well, that's well and dandy, and when you apply that to an 83% sellable efficiency, these are the end prices that we will sell today and hope stick 4 years into the future. Let's bring back those green dots and remind ourselves of what affordability is going to look like in those conditions into the future. And what used to be okay is now starting to look not so good. So if we bid up that, and particularly here in the high-risk scenario, you would argue a 21% gap in affordability from the price that we'd be selling today looks kind of nervous. And you say, well, hang on, let's pull this one out of our sleeve again with a 30-year AM. And even with 30-year AM, assuming it still exists back in the future, we're in trouble. So the real risk to this scenario, and let's talk about what those numbers were again. This says land prices go up by $12 a foot. Hard costs increase by 10%, and that in 4 years from now, mortgage rates are up to 6.5%. That's your high-risk scenario. That's a pretty, you call it high risk, may not be all that far off where we are. So really it comes back to what happens this year is going to be a big driver to what we're looking at in 2015 and 16. So on the condo investment backstop, I want to do a little bit of look at the math. If you're a all-cash buyer of a condo and you bought a typical condo, and that for this region is a 1-bedroom plus den, and it's in these two TREB districts, C1, C8, which is the downtown Toronto. So if you bought that in 2007, you paid $297,000 for that unit. You've now received delivery of that unit, and if you're renting that out, you're receiving about $1,700 a month. Back out your maintenance fees, back out your taxes, you've got an NOI of about $12,500. $12,500 on your original purchase price is looking like it's capping at about a 4.2 cap, and you've probably enjoyed a capital appreciation of 40%. That feels real good. It feels really, really good. Which might encourage you to then go and buy that unit again today, which is now priced at $415,000. And if you're an all-cash buyer, and you're a pretty conservative all-cash buyer, you're going to say, I don't believe rents are going to be any more in 2015 or 16 than they are today. That's fine. So I will assume I'm going to get that same $20,000 in rent, back up my costs, and I will be sitting on a 3 cap. Which I could argue, why don't you just go buy cap rate? It's an implied 5.6%. You know, Tom Schwartz is a good manager. He'll give you that, you know, income. The people that are buying these kinds of units have no interest in buying a security. They have no faith in that security, and they perceive this to be a place where they would park their money. And really, 3%, you're an all-cash basis, you're pretty good. This pencils out. The problem happens when you don't have the money. The problem happens when you have to go and actually borrow some of that money to go and invest in that unit. So we did a little bit of an analysis here on break-even rents. If you're at 20% down payment, how much do rents have to move up at these interest rates to pencil out and break even? It would suggest that if you're buying that unit at $415,000, you would need rents to move up by 44%. In that time period, or if rates go up to 6.5%, you would need to see those grow by 68%, or you're feeding this thing. You're feeding it $800 to $1,200 a month if you're putting down 20%. If you look at it at 50% down payment, this actually starts to hold water. So if you're a real investor in these things, you're either going to be prepared to start to feed this as your savings account, as many people actually do, or you better not buy 2, but maybe just buy 1 and be a little deeper in on the equity on this one. The risk from a developer's perspective, and this is maybe a little fine point, is that in the event that in the closing risks they don't show up to close, which is likely, if that is a likely situation, the developer would be left trying to find $332,000. Affordability is probably going to be something in $386,000. So very likely, what would happen is they just sell to somebody else. But if they don't, what this pencils out is the developer is in no real different a situation than that condo investor is, where they're going to have to either step up with some deposits and become a landlord, or they're going to have to top this thing up with with an additional monthly carry. Additional risk for the developer here is once they become a landlord, their HST credits start to fade away. So that's something I think may be really relevant for the group here on tax. So a sum up on the stress tests. From a housing affordability perspective, where you see rates now and values now, we're in pretty good shape. We do have some risk associated with increasing rates, but really not that dramatic. When we look at supply, the kind of supply I think we need to start thinking about is less oversupply and more undersupply. When we look at the current relationship of the pro formas, if we keep prices in check today, we hold those prices in line, we should be okay. We just got to figure out how you absorb those costs into your bottom line. If we absorb all those costs and take them to the market and sell them, 4 years from now, there's a very good chance that you're going to start to see some material closing risks in the marketplace. From the investment rental backstop, golden. All cash buyers and deep equity buyers, this actually is a very solid place to invest your money. If you have no money, don't invest in this space, please. So a few things that I just wanted to just close on a little bit. I think as we move ahead into this new era, really we are all in this together. So everyone's individual actions on this, whether you're the industry, whether you're the government, whether you're the consumer, whoever you are, you have a stake in this. And the decisions that you make relative to this are absolutely vital. I'm going to argue that the decisions that you make this year are probably the most important decisions that we're going to make relative to the health of our region, of a $22 billion a year economy, and what that means to the future of the size and the shape of the people that will be housed here. I understood, and I want to just touch a little bit of this because I know there's a number of people in the room that are looking at this from a retailer's perspective. Some of the challenges that residential development imposes on retailers is to try to figure out where all this stuff is happening. So that's a really important question, knowing accurately, because you've got some networks, you've got existing stores, you've got capital requirements. Do you have new stores? Do you expand existing? Do you consolidate existing? It's very difficult to do without hard facts. The good news is that those hard facts exist here today. And some of the things that we do, I think might be relevant for some of the retailers in the room. It's all about helping people make better decisions. The databases that we have and we offer through standard access to everybody, available for retailers, but for retailers, we do some really neat things. We provide unique extracts of the housing data into their GIS, where they can be layered on into their environment to measure it with existing internal data and with other third-party data, and as well as provide some training, because ultimately it's about the decisions that you make and the actions you take that are going to be determining of the outcomes that you have. So I wanted to end with a few questions, since the polling, I think, you're probably all wondering when you could get back to your BlackBerries. So here's a good reason to do it. I want to introduce 3 questions. 2 of them are for the retailers in the room. And then the last one's going to be a recap of what you thought about the condo market. So here's the first one. What's the biggest opportunity? You see a lot of growth. We see 45,000 units being sold each year. We have 100,000 people that move into the region. There's a shift between low-rise and high-rise. Where is the opportunity associated with new homes and condos for the retailers? Is it expanding your stores? Is it intensifying your existing stores and your trade areas? Or is there no opportunity whatsoever in this? So clearly some sentiment around the housing shift towards intensification. Everybody else was trying to click through this. No opportunity. Okay, that's good. Go to the next one. Okay, so let's go to the next one. So if those are the opportunities, this one's going to try to identify where as retailers, where are your challenges in addressing those opportunities? Is it the procurement of those sites, whether you're buying them or whether you're trying to rent them? Is it in the assessment of your location priorities? Do I go, downtown west? Do I do downtown east? Do I go to Markham? Do I go to Mississauga? Or is managing your time? When do I go there? Do I go there now? Do I go there later? When do I have a facility? Where would your biggest challenges be? It's about timing. Timing is everything, isn't it? Okay. That's great. Thank you. So my last question is my first question back to all of you. So this is going to take you back to what we asked in the very beginning about the condo market. Let's see if you can...
We can do a show of hands.
Let's do. Okay, well, let's do this. I'll tell you the questions, and then I'll go one at a time, and you can throw up your hands. So, is there a problem in the GTA condo market? We're back. Okay, good. So we're back. So, is there a problem, and do you expect a major correction? Is there a problem, and do you see modest correction? No problem. And the honest answer after listening is I still have no idea. No idea. No idea. That's right. Thoroughly confused everybody now. That's great. Mission accomplished. That's interesting. Okay. Well, that's great. That's great. So it's all about your decisions. I thank you very much for listening to me, and I'm delighted to be here this afternoon. Thank you.